Welcome back to the Deep Dive. Today we're tackling California Water Service Group, tickers, CWT. They had their Q3 earnings call on October 30th, and let's just say the market reaction was pretty rough.
Yeah, it's a classic utility situation unfolding here. They reported earnings, GAAP to diluted EPS of $1.03. Now, that was flat year over year.
Flat sounds okay on the surface, especially since they're in that really difficult third year of a rate case cycle, right?
Operationally, holding flat isn't the worst outcome, no. But the problem was expectations. The street was looking for something closer to like $1.20, maybe $1.22 per share.
Okay, so a pretty significant miss then. 17 cents, is it 19 cents below consensus?
Exactly. And the market didn't waste any time reacting. The stock dropped nearly 5% right after the print.
Which brings us to the core of this deep dive. Why did the stock tank when, listening to management on the call? They sounded pretty constructive, almost positive even.
That's the puzzle. They barely touched on the misses. Instead, they spent almost the entire call talking about regulatory wins and capital execution, future-proofing, basically.
So our mission today is to figure out what they see that the market maybe missed. What's this regulatory fortification they seem so confident about, especially when usage numbers looked weak?
Well, let's start with that miss first, just to set the stage. The numbers that cause the immediate pain.
Lay it on us.
Okay, EPS, like we said, $1.03, flat year over year. Revenue was $311.2 million. The consensus was more like $321.3 million, so yeah, a $10 million shortfall there.
Now, water utilities usually have these mechanisms, right? Like the M-WRAM, the Modified Water Revenue Adjustment Mechanism. Didn't that cushion the blow from lower usage?
It did kick in, yeah, but it just wasn't enough this time around. So on the plus side, they got a $12.7 million boost from approved rate increases. That's good. And the M-WRAM added another $3.7 million. That mechanism basically lets them track and eventually recover revenue lost when people use less water.
So that's what, $16.4 million in positive drivers combined? But revenue still missed by $10 million. The usage drop must have been pretty dramatic.
It really was. The big drag was an $8.1 million negative impact, specifically from lower water consumption, people conserving, basically. And here's the sort of technical issue. M-WRAM helps recover lost revenue, but it doesn't fully cover increases in fixed costs when volumes drop.
So things like interest expense, depreciation from all their new pipes and plants.
Yeah.
Those costs kept rising even as volume fell.
Precisely. They're spending a ton on capital projects, so depreciation is climbing. That, combined with the usage dip, really squeezed the bottom line, kept EPS flat despite the rate hikes. Management tried to spin it, saying holding flat showed good cost control in a tough year.
But the market just saw the miss against consensus.
The market saw the $1.17 miss. End of story. For that moment, anyway.
Okay, let's pivot to what management wanted to talk about, the regulatory side. Because that's where things get interesting, especially with the big California general rate case, the 2024 GRC. Delays there can be brutal for utilities.
Oh, absolutely devastating historically. If a big GRC decision gets pushed past its effective date for CWT, that's January 1st, 2026, the utility is stuck operating on old, lower rates. It can wreck cash flow for, well, sometimes years.
And that risk was on the table here.
Very much so. The administrative law judge, the ALJ, even flagged that the case is complex and might not be decided by that January 2026 deadline. That's usually a huge red flag for investors.
Right. Uncertainty is poison for utility stocks. But CWT seemed to think they dodged this bullet.
They basically engineered, let's call it a regulatory firewall. It's pretty significant. First big piece, the ALJ gave them permission to file for an interim rate increase starting January 1st, 2026, if the final decision is indeed late.
Wait, an interim increase? How does that work?
It's tied to inflation, specifically CPI. So even if the main GRC decision gets delayed into 2026 or beyond, they're guaranteed some kind of rate hike based on inflation hitting on day one.
Sounds like a game changer. Usually a delay means zero rate increase until the final order comes down.
Exactly. It turns a potential multi-year period of falling behind on costs into, well, at least a bridge linked to inflation. It takes a huge chunk of that regulatory lag risk off the table. The market often punishes CWT for fear of this exact lag.
Okay, but playing devil's advocate, if it's only tied to CPI and their actual costs, like that rising depreciation we talked about, are going up faster than general inflation, it helps, but doesn't fully solve the problem, does it?
That's a fair point. It's not a perfect fix for all cost recovery during a delay, but and this is the second part of the firewall, the ALJ also approved a memo account.
A memo account, meaning?
Meaning they can track all the revenue and costs they would have collected if the GRC had been approved on time starting January 1st, 2026. So any shortfall between the interim CPI rate and what the final GRC eventually approves, it's all tracked and becomes recoverable later.
Okay, got it. So the interim rate provides immediate cash flow relief tied to inflation, and the memo account ensures they eventually get made whole for the full amount once the final rates are set.
You nailed it. Between those two mechanisms, they've basically secured their 2026 revenue pathway, even if the GRC decision slips. It removes a massive historical uncertainty. Management actually gave credit to the commission for being collaborative on this.
That's a huge de-risking event that seems like the market completely glossed over with that 5% drop.
It seems that way, yeah.
Yeah.
Focused on the rearview mirror miss, not the road ahead being paved.
All right, regulatory certainty is one pillar. The other big one for utilities is actually spending money, capital deployment. That drives rate-based growth. How did they do on that front in Q3?
They're definitely putting capital to work. Q3 infrastructure spending was $135.2 million. That's up almost 15%, 14.8% year over year.
Wow, that's aggressive growth. What about year to date?
Year to date, they're at $364.7 million, also up nearly 10% compared to last year. So yes, the investment engine is running strong, which is what supports future rate increases.
But spending requires funding. We're in this higher for longer interest rate world. How are they managing the financing for all this capex?
They pulled off a pretty significant financing deal right at the start of October. Closed on $370 million in long-term debt. It was a mix of senior unsecured notes and first mortgage bonds.
And how did that go? Were they able to get decent rates?
Apparently, incredibly well. Management said it was the most oversubscribed bond offering their team had ever handled.
Oversubscribed is good news for the borrower. Means lots of demand.
Exactly. High demand usually translates to better pricing. They locked in rates ranging from 4.87% up to 5.64%, with maturity stretching all the way out to 2055. So pretty favorable terms, all things considered.
And did that help their overall debt picture? Like reducing reliance on short-term borrowing?
Yes, that was a key part of the strategy. That $370 million raise allowed them to pay down $355 million from their short-term credit lines. So it immediately shifts the debt profile to longer-term fixed rates and strengthens the balance sheet against, sudden spikes in short-term interest costs.
Okay, that makes sense. But even with that financing, there's still this massive elephant in the room for water utilities, PFAS contamination. The cleanup costs are projected to be huge. What was the update there?
Yeah, PFAS is a big number. They estimate needing about $217 million just for treatment investment between 2025 and 2029. It was a major potential drag on earnings and affordability.
So how are they planning to pay for that? Is it all just going to hit ratepayers eventually?
Well, this is another area where they're being proactive using litigation. They managed to secure another $24.2 million in net proceeds from PFAS settlements just in Q3.
Net, so after legal fees and everything?
Correct. That brings their total recovery year to date to $34.8 million net. And critically, that money is specifically set aside.
Earmarked for
to directly offset the capital expenditures needed for PFAS treatment. So instead of the full cost hitting the rate base immediately, these settlement funds cushion the blow, keep rates more affordable, and reduce the amount of external financing they need for this specific mandate. It's smart financial management.
Good to see they're finding ways to mitigate that. Anything else on the regulatory front outside of California? Sometimes those smaller states add up.
They do. It's part of the diversification story. Let's see. The Hawaii PUC approved a $4.7 million rate increase. In Washington, they filed a new GRC looking for about $4.9 million. And down in Texas, their BVRT subsidiary is close to getting final approval on a full settlement in its rate case.
So steady progress across the board, adding incremental growth.
Yeah, nothing explosive, but positive movement in all those jurisdictions, which helps balance the focus on the big California case.
Okay, let's zoom out a bit to the longer-term picture. Management's projecting some really punchy rate-based growth, nearly 12% compounded annually. That sounds high for utility. Did analysts push back on that?
They did, yeah. A 12% CAGR is definitely ambitious, but management's defense was basically, look at our track record.
What's the track record?
They pointed out that over the last 10, even 15 years, their capex growth has compounded at around 10% annually.
Okay, 10% capex growth, historically. Why has it been so consistently high? Is it just replacing old stuff?
It's largely that, yeah. driven by necessity. Think about where CWT operates, primarily the West Coast. A lot of that core water infrastructure, the big mains, went into the ground during the post-World War II boom.
So 60, 70, 80-year-old pipes.
Exactly. A lot of that infrastructure is reaching the end of its useful life all around the same time. When a major pipeline fails under a busy street, replacing it isn't really optional, it's mandatory spending. So that historical 10% capex growth isn't just discretionary, it's driven by the need to replace critical aging assets. That makes the forward-looking rate-based growth forecast, much more credible.
And underpinning all this for income investors is the dividend, right? Still reliable.
Absolutely rock solid, it seems. They just declared their 323rd consecutive quarterly dividend. That's quite a streak. And more importantly for growth, they announced their 58th annual dividend increase. They hiked it 10.71% for 2025. So even with near-term earnings wobbles, that commitment to returning cash to shareholders is clearly still a top priority.
We have to touch on the macro risks again, specifically interest rates. This higher for longer narrative really hits capital-heavy businesses like utilities. How are they defending against rising borrowing costs beyond that recent debt deal?
They highlighted two key things. First, in California, they have what's called the two-way cost of capital adjustment mechanism.
It's the only way mechanism.
Yeah, it's important. Unlike in some states where you're stuck with your approved borrowing costs until the next big rate case, this mechanism lets CWT go back to the commission between rate cases mid-cycle and ask for adjustments to their allowed return based on significant changes in interest rates.
So if rates spike, they can potentially get relief sooner rather than later. Helps protect their authorized returns.
Precisely. It reduces that regulatory lag risk associated specifically with fluctuating capital costs. And the second defense, as we discussed, was that $370 million long-term debt raise. Locking in those rates now provides insulation against further near-term volatility.
Makes sense. Now, while California gets all the attention, you mentioned Texas BVRT. That sounds like maybe the more exciting growth story long-term.
I think that's where a lot of the future potential really lies. BVRT operates in that booming corridor between South Austin and San Antonio. It's just exploding down there.
What kind of growth are they seeing?
Well, year to date, they added about 1,100 new customer connections, which is solid. But get this. They have another 15,500 connections that are already committed. Yeah. Developers have paid deposits. They're just waiting for the homes and businesses to actually be built.
15,500. That's massive future growth baked in.
It really is. And the whole region is projected to grow to something like 8 million people by 2050. So unlike the mature California markets focused on replacement capex, Texas offers this pure organic growth from new development. It's a very different, potentially much higher growth profile.
Okay, this has been super insightful. I feel like we've really unpacked the layers here. Yeah. Now it's time for our segment. This is not financial advice, where we put on our metaphorical hedge fund analyst hats and pitch a trade idea based on everything we've just discussed.
And the mandatory disclaimer kicks in. We are analyzing information from the earnings call. This isn't personalized investment advice, just a thought experiment for you. Please do your own research.
Absolutely. Okay, here's the setup. That nearly 5% stock drop. We argue that was almost entirely a gut reaction to the headline Q3 miss, specifically the temporary dip in water usage. Classic rearview mirror investing.
Right. Traders saw the miss versus consensus and hit sell without necessarily pricing in the forward-looking regulatory wins we spent so much time on.
Exactly. So the trade idea is this. Consider a near-term long position. You're basically betting against the headline panic and on the structural regulatory certainty that management just locked down for 2026.
You're trading the information gap, essentially.
Precisely. We're not betting on more rain or less conservation. Mm-hmm. We're betting that the market hasn't fully appreciated the impact of that guaranteed inflation-linked interim rate increase starting January 1st, 2026, plus the safety net of the full recovery memo account.
So the thesis is that this combination dramatically reduces the historical risk associated with California GRC delays. And once the market fully digests that de-risking, the stock should recover at least some of that reactionary 5% dip. You're betting on the regulatory mechanics overpowering the temporary volume softness.
It's a trade based on regulatory structure, not weather patterns. Plausible, maybe. Outrageous. A little bit. That's the fun of it.
So wrapping this up for you, the listener, you've got this tension. A clear Q3 earnings miss driven by lower usage, which the market obviously disliked. But on the other hand, you have these really significant regulatory and financial moves that seem to build a much stronger foundation for 2026 and beyond.
My final thought for you to chew on is this. Look beyond the California GRC drama for a second. Focus south on Texas. That BVRT subsidiary has 15,500 committed connections waiting in one of the fastest-growing regions in the country. Ask yourself, at what point does that Texas growth engine become so powerful that it starts to fundamentally outweigh the inherent regulatory friction and complexity of the core West Coast operations?
That's definitely the key strategic question for the long term. Is the future growth in Texas strong enough to change the narrative? A lot to consider. Thanks for joining us for this deep dive on CWT. As always, check out the company's filings and do your own homework.
We'll catch you on the next deep dive.